More? How's it going, guys? Welcome back. My name's Paul, and if you've never seen me before, I've recently started investing and I'm trying to figure out how this investment thing works. What I'm trying to do is learn as much about investing as I can, and one way of helping me understand everything is by making these videos. As I learn something new, I try to explain it to camera, and that helps things go into my little head. And in the past 2 weeks, the biggest news is that Apple and Tesla have decided to do a stock split. Now, I wasn't going to do a video on stock splits because I thought they were kind of simple. There's not really much to it. You take your share and you split it down and you get more shares, but they're made up of the whole. Yeah, it is what it is. This is quite a good analogy for the 4% rule. However, this thing has seemed to cause a ridiculous amount of confusion, and a lot of this relates to trading 212. So I figured it might be a good thing for me to take people through it. So stick around to the end because I will be discussing exactly what's going to be happening to your stock splits in regards to trading 212 specifically. And also, if you do find this video helpful or entertaining or, interesting for whatever reason, please feel free to give it a like and subscribe down below. So like I said, I wasn't really going to touch the stock split thing because it doesn't affect me too much. But I do realize it does affect a lot of trading 212 users, so it's worth talking about. It's also very important to remember that the stock split isn't really anything to do with mathematics, and it's much more to do with emotion as far as investing goes. And I feel like that part of investing is something that I do understand. The Trading 212 forum and our Discord went mental with questions about the stock split and how it might affect them. And Brian sent an email yesterday asking if it was even important or if it was just Apple and Tesla up to their old tricks. In particular, the Trading 212 forum went absolutely mental, and it was really hard to find the actual answer as to what was going to happen. So let's break it down, bring it in really simple, and let's talk about it. So, Apple and Tesla have decided to do a stock split. That's where I think Apple's going to go 1 to 4, so 1 share is now going to become 4 shares, and Tesla I think is 1 to 5, where Tesla is going to go from 1 share to 5 shares. So one of your Tesla shares is going to be split into 5. What's key to remember here, because I don't think everyone gets it yet, is that it will make no difference to the market capitalization of these companies. The stock price itself will lower, but there will be more shares. So the overall value of the company doesn't change in any way. Lots of people are genuinely asking that if it makes absolutely no difference, then why? The single share that you own will go from 1 big one down to 5 little ones. I suppose you get to say that you own 5 shares of Tesla now. Stock splits are very common. They happen all the time. Apple's done quite a few itself in the past. It's usually a very good sign that the stock has done so well that its price is just a little bit too much. And they want to bring that price down so small-time investors like you and me can get in on the action. Large investment funds hate stock splits. That includes mutual funds and index fund owners. This is because every time that you buy into a mutual fund or an index fund, that company that owns it, like Vanguard or Fidelity or something like that, they have to buy that stock. These big investment firms have to pay quite a hefty commission when they buy these stocks. So when Tesla is sitting around 1,500, they only have to buy that stock once. But now it's split into 5, they might have to buy it 5 times. That's a lot of cost. These firms also don't like it because stock splits make no mathematical sense. The price of the stock doesn't change. You don't get more for less. I just want to clear that up for sure, just in case there's anybody that does think that they're actually going to get more shares of Tesla for less money. There is a small group of people out there that still believe this. However, even though the stock splits are totally irrelevant mathematically, Tesla's stock price still jumped 13% on the news. This might prove that the real world application of a stock split is actually very relevant. The real reason for these stock splits is completely emotional. Apple and Tesla know exactly who their investors are, and it's young people with relatively little money who believe in their products and believe in the future of their companies. Because the share prices have gone up so much, Apple and Tesla believe they can get more investors by making their price look cheaper. I understand this because I know it feels a lot better to have whole shares rather than loads of fractionals. And so if Tesla drops its price, it might make it more attractive to retail investors. And I think the 13% rise based off the news does show that it probably will work. I'm not sure what it says about Tesla investors as a whole. If I was a late-coming, die-hard Tesla investor, I'd be kind of worried that so much emotion has just entered my market. And I'd be very worried that all these new investors might not be as strong-willed as I was. And I wouldn't like to be buying in at this high market capitalization because I'd be very scared that some of these people will jump at the first sign of bad news. However, more investors means more growth, so there's arguments on both sides here. But stock splits make absolutely no difference to the price. However, when they're applied in the real world, they make a big difference. It's the same thing when I hear people say that dividends are irrelevant. If you're not familiar with my channel, I've decided to follow the dividend investment strategy. It's something that I've chosen to try out because it makes a lot of sense to me. At the moment, my portfolio is sitting at 11,558. I've built up this portfolio of companies that I think are going to do very well in the future based on the fact that they have dividends. Now, I'm very aware that nothing about this strategy means that I am going to perform better. There's plenty of evidence out there that suggests I won't. If I was looking to take less risk, then I'd be much better just getting myself in an index fund. That is probably the best way for everyone to do it. But for me, I don't feel index fund investing is going to keep me engaged enough. You see, what I have learned about investing is that the biggest enemy to my portfolio is probably going to be me. The benefits and pitfalls of stock picking mean absolutely nothing in comparison to the damage that I could do to my portfolio if I was to get too emotional. Index funds for me also mean that I might not get emotional enough, as in I might stop caring. As in, I might stop actively trying to put in as much money as I can every month. Because that's the most important thing to investing over anything else. You've got to keep putting as much money as you can into the market. You're not going to grow your wealth by just putting in one lump sum and trying to make 100% returns all the time. That only works for a very small and dedicated amount of people. I do know that when I earn a dividend, the stock price drops by the corresponding amount, which mathematically makes them irrelevant. But when applied to the real world, the hike of a dividend or even the cut of a dividend makes a massive difference to the stock price. It makes a huge difference to the company. So when we say that stock splits and dividends are irrelevant to the price, they are. But when you apply them to the real world, they make a massive difference emotionally. They send stock prices up and they send them down. Because ultimately, it's investor sentiment that drives the market. That was a bit of a tangent. Okay, that's a bit of a tangent. I wanted to touch on dividends being irrelevant, but that's gone way out of hand. But yeah, the dividend investment strategy isn't necessarily going to return a massive return, but the return through my own contributions should be much bigger because I'm more emotionally invested in it. I hope people understand that because the biggest driver in your returns is going to be how emotionally invested you are in your investments. So if it keeps you emotionally involved and not selling all the time as a growth investor, that's great. If index funds are going to work for you emotionally, then that's even better. That's the perfect strategy. But for me at the moment at least, dividend investing is keeping me involved and I'm clearly putting in a lot of money because of it. Fucking more tangent. So by accepting that stock splits and dividends are completely irrelevant, you're accepting that the stock market is completely priced in perfectly all the time. Which it fucking isn't. Tesla and Apple are using these stock splits as a driver to get young investors to buy more. It's a very emotionally manipulative tool that's driven by two very emotionally manipulative companies. Okay, trading 212 stock splits because this is important and I just want one central place for everybody to know exactly what's going to go on. If you look at the Tesla and Apple stock split threads on the forum, they are absolutely insane. There's so much information on there, and it's very hard to find the little bit that someone from Trading 212 has told you exactly what's going to happen. And even though they've told you what's going to happen, people around it still speculate. So here you go, this is the latest advice from Trading 212 as to what is going to happen with your stock split. With the Tesla stock split, your one share of Tesla is going to split into 5. So if you own one single share of Tesla, it will now become 5 shares. However, if you own fractional shares, you will not get any split shares. All of your fractional share will be sold and given back to you in cash. So if you own 0.5 of Tesla on stock split day, your share will be sold and you will get the cash value of that share at that present time. If you own 1.5 shares of Tesla right now, you will get 5 new shares of Tesla at the lower price, and then your 0.5 of a share will be sold back to you. That's it as of the time recorded. I highly doubt that they're going to improve the system so much that they're going to be able to offer you fractionals of fractional shares. I just don't think that's going to happen in the time frame, and Trading 212 haven't indicated that they are actually going to do that. So if you have any whole shares, they will be split into 5, and if you have any fractional shares, they will be sold and the money given back to you. This will happen exactly the same with Apple. It is a little less clear for anyone using Pies because that hasn't totally been cleared up yet, but it's most likely that Pies is just an overlay on top of your entire portfolio. So if you head out back into the investment section, that is where your calculation is going to be done, and the Pies will probably be split accordingly based on the information in your investment section. That's a little bit more complicated, but it should still be pretty simple. A big question now is what the future of stock splits are going to be. With Apple and Tesla getting so far away and now doing their stock splits, I think other companies are going to have to follow suit. You can safely say that Apple and Tesla are trying to make themselves more appealing to the smaller investor, but you could also probably say that they're trying to avoid a market crash. You've got to admit that Tesla looks proper parabolic. When that stock price goes ridiculously vertical, history suggests it comes down pretty quick as well. By reducing these share prices, it might make them look like they're not as disconnected as they actually are. It could genuinely slow down the tech bubble if everyone got on board. Will other companies follow suit? Probably, yeah. Amazon and Google are probably crunching the numbers as we speak. They're probably going to find that the announcement of a stock split massively boosts their price. And in the same way that Apple and Tesla think they're going to benefit, they will probably benefit as well. However, some companies like Microsoft and Netflix might not benefit as much. Remember, we're thinking very emotionally here. Netflix will have to think about whether going from $500 down to $100 will actually benefit them and not make them seem like any normal company. And I know it doesn't make sense, but emotionally, people will be driven by this. So who could benefit from a stock split? Google and Amazon are two very obvious ones, but maybe McDonald's or Nvidia or Zoom, Home Depot, Costco. Any stock that you look at, you see the price and you go, maybe I don't want to spend that much today. If McDonald's brought down its whole share to $50 or $25, think how many young people are going to lap that up. But on the other hand, stocks like Square, Alibaba, KLA, AMD, they probably wouldn't benefit from a stock split. Their share prices right now do make them look like they're competing with the likes of Microsoft. They appear, without looking at the market capitalization, which I'm sure most Robinhood investors don't do, they look like they're valued the same as Microsoft. I know this is all based on emotion, and I know it shouldn't be, and I know it's based on the idea that younger investors don't do their research and they don't understand how the stock market works, but I think Apple and Tesla know that, and that's why they're doing it. Thanks very much for watching, guys. The app I use for investing is called Trading 212. If you wanted to get into investing, you can sign up through the link in the description below. If you sign up through that and make a deposit, you get a free share and I get a free share as well. Also, if you wanted to talk with other like-minded investors, feel free to come into the Discord. There's a link in the description below for that as well. We must be pushing 2,000 members in there right now. As always, you need to remember that I am not a financial advisor. I have absolutely no clue what I'm doing, and I literally record these videos as I learn things. Please do not consider any of this as financial advice. But if you did enjoy this video, found it interesting or helpful, please feel free to like, subscribe, and invest. I'd love to say that this is how the 4% rule works in a recession, but it's not always like that yet. God, I love cookies. Cookies and beer.